hello and welcome to Closing Trades right here on ET. Now, a little wobbly, that's how the trade is, much unlike what we had in store yesterday at the same time for sure. Well, we're comfortably above the 24,100 mark for the Nifty futures, and I think that is the key sign that we finally come out or snapped out of that range that we've been stuck in for so long, wherein 24,000 definitely was acting as a big hurdle for the index. Today, of course, it's ONGC all alone, which has really pushed up the index higher, over a 5% move on that stock alone. There's, of course, Tata Motors as well, even though the monthly sales data wasn't all that impressive, but that stock pushing higher by 3.25% right now. There's Britannia, Nestle, Tata Consumer. The entire staple segment is also seeing some buying, and Reliance today is holding up nearly 1%, so that definitely is comforting the index as well. Talk about the broader market, and while there it is the declines once again which are taking over. So Angel One, Kalyan Jewelers, Zomato, these are all stocks which are lower. But look at the moves on a DMart, for instance, 11.5% of an uptick coming in. IGL, REC, Chola Finance. These are all your big winners. But again, you can't really draw up a sectoral trend. Even if you talk about the biggest gainer today, that's the oil and gas sector. That's also seeing the major moves contributed by ONGC alone, Anisha.
Well, yes, but let's put the spotlight on some of those stock and the newsmakers that you talked about. Avenue Supermarts brokerages have been still maintaining underperform as far as Macquarie and Morgan Stanley are concerned. The target prices are substantially lower at 3,700 rupees, but CLSA has an outperform with 5,360 close to the current market price. CGDs are in focus separately. IGL, for instance, is up around 5%. Mahanagar Gas is also active. That after there has been increased supply coming to them. So ONGC and GAIL have been asked to redirect some of the supplies to them. Remember, supply was a challenge for some of these companies. So getting eased out is a good news. REC, as I was talking about, has been seeing quite a bit of upmove since the start of the day on account of that NK initiation, wherein they have initiated coverage both on PFC as well as REC. The target price is between 600 to 630 rupees a piece. But recently, the news that we got and what we want to address is, of course, the loan disbursement data, which is out. The total loans disbursed in Q3 were up 18% year on year. And if you look at the specific renewable loans, that's up 58% year on year. So that's the latest news flow that we're tracking. Both of those stocks are in focus on account of that. But we do have Shibani Sarkar Korean joining us on the show and Naresh joining us on the technicals. Naresh, let me begin by asking you a bit of a moderation from the highs of the day, but is 24,000 that floor that one needs to watch out for?
So I would expect 23,900 to 24,400 should be the new range for the index. The only concern is the bank Nifty has not made a similar recovery. And we continue to see the largest weight, HDFC Bank, not able to sustain that 1790, 1800 mark. So we remain in this consolidation, say a little bit of a bounce back coming in oversold sectors. Say yesterday it was auto, today it is FMCG. So that tells you we are still in a consolidation, but 23,900 now becomes a pivot point for the momentum.
Okay, that's the take coming in on FMCG. Let's welcome on board Shibani as well. Shibani, hi, afternoon, and firstly wish you New Year greetings from all of us.
Hi, and wish you all a very happy New Year as well.
Right. Shibani, tell me, is it going to be as happy for FMCG? You think staples will finally bottom out, or do you sense pressure will continue?
So it's been a mixed bag where the entire consumer and staples pack goes. What we have been noticing and what management commentary over the last few quarters has been that while the urban demand has been somewhat slowing down, there is an uptick that we are seeing on the rural side. So overall, it's still a fairly mixed bag in terms of growth. And even if you saw the last quarter numbers, the volume growth numbers were fairly muted. However, what we are seeing is that from a rural perspective, demand does seem to be improving. With inflation now seemingly coming under control, especially food inflation, real rural wages are finally, after a very, very long period of time, showing some signs of improvement. Data also seems to corroborate that there is some uptick where rural employment is concerned. And that, along with, of course, the good output in terms of the crop, both Kharif and expectation of a good Rabi, is supporting rural demand. So at this point in time, our view on the staples segment is still fairly mixed. We are looking at companies that derive more demand coming from the rural side, while urban demand has been slowing down. Valuations in pockets are still not very cheap. However, compared to their long-term history, valuations are close to their long-term averages. So therefore, we have been fairly stock specific where the entire consumer and the staples pack goes.
The take coming in on consumption, yes, hopefully that the sowing season turns out to be better, and that really supports the sentiment as far as the farming community is concerned. But taking stock of ONGC and Oil India, a couple of news flow around it. Naresh, of course, there was that brokerage note with a 58% upside coming in from Jefferies this morning on ONGC. But the fact that the oil prices have finally managed to get out of that barrier of $75 and it's now at close to 2 months high, that's also supporting sentiment on Oil India. What do you like from the energy basket?
So the whole basket looks interesting because the extent of correction has been large. So if you look at ONGC, the stock corrected from 340, 45 levels all the way to 235 levels. So that's more than a 30% correction. And the bounce back even now, it's still down 25, 30%. So out here, slowly and steadily, there should be a rally. Any dips back to 250, ONGC still looks interesting. Same is the case with Oil India. The stock is back at the same place where it was almost 8 to 10 months back. The stock has corrected from 750 all the way down to 430 odd levels. After today's move, also any fade off move in the next two sessions, say closer to 470 odd levels, would be a good buying opportunity for Oil India.
Right. Okay, that's the take coming in some of those oil and gas names which are definitely on a tear. But Naresh, what's your observation within the auto pack? Because some of the auto majors which have not come out with such great numbers also for December sales, they too are flying up. Does it seem like auto is making a comeback and a meaningful one at that, or do you think it's too early to say that?
So if you look at auto, the reasons for the bounce back in a lot of names is because these stocks corrected almost 30% from the top. So that is where we are seeing a bounce back. Even in the Tata Motors, which has corrected a lot, we are seeing bounce back in the last 2 days. But this is a bounce back trade, then we again go sideways. Say Maruti also, we go to say 12,400, 500, then again go sideways. But the leadership has clearly been changed. Eicher Motors, which we are looking at for quite some time, as the relative outperformer, has broken out into new all-time highs. So going forward, every day, Eicher Motor becomes a buy on the two-wheeler side. Mahindra and Mahindra has consistently been an outperformer. So those two will remain outperformers and bounce back trades could continue. So at current levels, Bajaj Auto looks interesting for a bounce back trade.
Today, of course, Avenue Supermarts is gaining while Zomato is down 3.5%. Do you think the street is making too much of that Q3 update that's coming from Avenue Supermarts? I mean, do you think that 10% move on Avenue is warranted and 3% cut on Zomato is warranted? Shibani, the question is for you.
That's for me. Unfortunately, we will not be able to comment specifically on stocks. It will be very difficult for me to comment on a particular name given our compliance requirements.
But help me understand, do you think people are making too much of this quick commerce disruption or we are making too little of it?
So if you look at quick commerce as a basket, I think there is a significant growth opportunity that is clearly present. One, the kind of expansion that you have seen so far is only addressing a very small segment of the total addressable market. And as you know that many of the companies which are in the quick commerce space today have adequate cash on their balance sheets. And therefore, there is room for them to expand into markets and geographies today which are completely untapped. So if you look at the presence of dark stores today, they are concentrated in the top 4-5 cities at this point in time. And therefore, from an expansion perspective, there is considerable headroom for growth. Having said that, is it likely that the entire grocery and the way food shopping takes place moves to the quick commerce platform? The answer is possibly no. And there will be some amount of segment which is catered to by companies which offer value, and therefore that particular segment of the population will continue to go to those kind of segments and stores which typically will cater to that kind of a population. However, in terms of growth opportunity where the entire quick commerce segment is concerned, we believe that there is significant room and headroom for growth. And as I mentioned today, most of the large players in the quick commerce space have adequate cash on their balance sheet, which means that expansion of stores, especially dark stores across geographies, is likely to remain fairly strong. And therefore, the growth numbers that will possibly come through will also remain strong, at least in the near term.
Okay, point taken. But since we're talking about quick commerce, hear out what Karan Turani had to say on the same.
So I think as of now, I think Blinkit will maintain its edge. That is what our assessment is broadly for now. Given the market leadership, given the kind of numbers they are posting, we don't see them gaining market share. We don't even see them losing market share significantly because they have got their moat. Whether you call it the location advantage, whether you call it the SKU variety, and everything put together, the higher AOV, higher take rate, everything. So I think they will maintain their moat. They will stand to be better and ahead of competition. As far as Instamart is concerned, I think definitely things are right now changing. If you look at Instamart's growth, I think you will see some kind of changes here post the listing. They will potentially look to gain market share as well over the near term. And at the other end, you've got Zepto as well, who's also executing reasonably well. And then you've got a large variety of e-commerce players who are wanting to get into quick commerce. So definitely the market is going to be fierce in terms of competition. The fragmentation is going to be fierce over the next 2 to 3 years. But I think Blinkit will maintain its moat, and there is a high likelihood that Swiggy Instamart will also make some market share gains over the near term.
Okay, on that note, we're going to take a very quick break. A clear, downtick is what you're seeing, at least on the QCom players. We'll take a break, analyze all of that and more on the other side.
Welcome back. Well, last year we did see quite a bit of outperformance from the likes of BSE, CDSL, CAMS, the other stock market ancillaries, but the latest reports are suggesting that the F&O volume has declined by 20 to 30%, and we are back at the volumes that we saw in 2022, 2023, and that's after the latest regulations have come in. In fact, Mr. Nikhil Kamath of Zerodha is saying that all the implications of the new regulations haven't been even come into effect as of now, and it's going to decline further from here on. Shivani, just wanted to get a better sense from you. What does it mean for all the stock market ancillaries, the likes of 361 or Angel One or other brokerage and trading platforms, even BSE for that matter, if the volumes do drop the way they have been over the last couple of months?
Yeah, so this is something that we will have to wait and see as to how the volume trajectory pans out. Clearly, at this point in time, there has been an impact in terms of volumes because of the regulatory changes that have taken place. And that is something that is likely to show through in terms of some of the numbers on the brokerage side. Now, in the entire capital markets segment, the way we have been looking at stocks and sectors within that space is that, if you look at companies which are in the asset management space or in the wealth management space, these are better placed at this point in time as compared to companies which are direct brokerage plays. And therefore, we believe that while near term, of course, in the last quarter or so, markets have seen volatility and that will result in some mark-to-market impact where AUM is concerned. But structurally, asset managers as well as wealth managers are better placed in the construct of the entire capital markets basket. In pockets, of course, we have to be mindful of valuations because in some pockets, valuations have moved up considerably. However, having said that, the way we are approaching the entire capital market basket is to look at companies which within the asset management as well as wealth management space, which offers a more structural runway and opportunity for growth.
Okay, that's that. Naresh, wanted to get you in on some of these capital market plays, and I recall discussing this with you earlier as well on where you see the likes of CDSL and Angel One, 361, or for that matter, even a BSE headed next because they've had a fabulous 2024.
So time for them to take a pause or maybe even a correction, given that we are seeing a top in terms of participation and it could remain at such levels or get lower. Even the cash market participation has reduced. And going into Jan, we see a change in lot sizes, etc. And many of these stocks have done really well. So if you look at the CDSL, it has been a one-way move all through the last one. Say from 2023 or in 2023, the stock was 600. Today it is 1800. So most of these names have done multi-X moves and now time for a pause. And you started seeing this, say first dip happen in the Angel One, which has the most direct correlation with F&O volume. So that has started cracking. So that could again go back to 2500 levels. So for now, one is better off avoiding these names, waiting for a correction, even if one has a longer term view.
Right. Okay, so that's on the stocks of some of these, market-related ancillaries. The market has moved into the red a bit, so 140 points lower, just around the 24,000 mark. But in terms of the stock-specific action, take a look at PTC Industries. That's flying away in the trading session. Lloyds Metals, if I remember it right, that was the stock that the Chief Minister was talking about, Fadnavis talking about how that stock is likely to do very well given the kind of employee kind of support it's getting in terms of the workmanship. Just Dial, ONGC, Bank of Maharashtra, these are some of the other names that we are watching out for. And of course, IGL and UPL. Shivani, chemicals was a theme that pretty much did nothing over the last couple of years. We have been talking about the light at the end of the tunnel, but now chemical experts are telling us that 2025 perhaps can be the year of reversal. And these are the businesses that have great operating leverage. If the cycle turns, the profitability will skyrocket.
Yeah, so I would still approach the sector with some degree of caution. It is possibly likely that most of the bad news is behind us, but improvement both in terms of demand as well as pricing is something that is likely to take some time. So if you look at what has actually happened in the chemical space, there have been two key factors that have impacted the sector. One, there has been significant dumping as far as Chinese competitors go, and that has resulted in decline where pricing is concerned. And there has also been a demand slowdown resulting in inventory destocking, especially in the case of global companies. Now, where global demand is concerned, we are possibly coming to close to an end in terms of the inventory destocking cycle. And therefore, from that perspective, it is possible that we will possibly be coming close to an end over there. Where pricing is concerned, and as far as Chinese competition goes, the competition continues to remain fairly strong, and therefore pricing action still remains fairly weak. We have not seen any signs of improvement where pricing is concerned. However, one thing is certain and clear that some companies which have invested in terms of building capacities, as and when the global demand scenario as well as the dumping from China starts to abate, these are companies that will be well placed, especially where specialty chemicals go in terms of getting back on track in terms of growth. However, we still see that a few quarters away. Valuations clearly have corrected considerably, and therefore, from that perspective, downside appears to be limited, but the upside will possibly still take some time to come through.
Okay, that's that on some of the chemical as well as fertilizer plays. Just looking at what IT is up to, and once again, you're seeing a slump there. Wipro, Techem, these are all stocks which are under pressure. Want to bring up the likes of Infosys as well, which is also down by about 1.25%. There's TCS2, which is down over 1% as we speak right now. Shivani, what's the sense that you're getting about how IT earnings are going to pan out this time?
Yeah, so typically, if you look at the quarter three is usually a muted quarter. Primarily, this is a quarter where you see a significant number of furloughs as well as holidays, which impact overall growth. And that's something that we have to keep in mind when we look at the quarter. I think what will be important will be one commentary in terms of demand, especially in large verticals such as BFSI, high tech, and the like. What we've also seen in terms of data points, banking as a segment, especially where North America banks are concerned, is starting to see some improvement as far as discretionary demand is concerned. However, this is still fairly early days. However, Europe continues to struggle, and Europe still forms fairly large part of the revenue pool, and therefore that is something that we'll have to wait and watch for. Where IT is concerned, we do believe that incrementally growth should start to recover, especially given that macro data in the US seems to suggest that growth is holding on. And we have now started seeing the rate cut cycle as well start. However, as I said, the key also will be to see how the rest of the world and North America pans out in terms of demand. Overall, if you look at the sector structurally, with the adoption of Gen AI, there is a huge opportunity for growth that should play through over the next couple of years. However, one must also remember that if you look at long-term growth rates where IT is concerned, high single-digit growth in terms of revenue is something that one should possibly look at, rather than extrapolating the kind of mid-teens growth that you saw post-COVID, where there was significant uptick as far as discretionary demand is concerned. Now, if you look at the sector in pockets, valuations, especially where some of the larger IT names are concerned, are fairly in line with where market valuations are. And therefore, we continue to be positive on the sector as a whole. However, as I said, this quarter, one should watch out for commentary in terms of deal flow as well as expectations going forward. The rupee depreciation will help in terms of margins, and therefore margins should remain largely stable. That is what one would possibly look for in this particular quarter for IT.
The expectations from IT and how you should position yourself on it. Shivangi Sarda also joining us on the show right now. Shivangi, what do you make of the chart of Tata Motors? Clearly on an uptrend.
Me on the show. So we've seen that Tata Motors has, in fact, witnessed a good short covering move. In fact, there is a negation of the last 5 months of lower top, lower bottom. So of course, this stock is poised for a good risk reward as well as, a good potential upside that we're seeing. So good space, on the upside, which is visible for this stock. Now, if we talk about the data, there has been a volume surge in the last two trading sessions along with the price rise. uh, has taken a good support near 700 odd levels. So the base is also becoming stronger at these levels. So definitely there's some steam happening here, and the stock is ready for the next immediate targets of 820 and positionally 850 levels. So one can position to buy it with a support of immediate 770 levels.
That's a take coming in on Tata Motors. But what about HDFC Bank? I mean, that's down 2.25% today. Yes, CLSA has taken that out of their portfolio, model portfolio, and added Tata Motors. So clearly you're seeing the divergent move on both of these stocks. But quite a bit of weakness on HDFC Bank, Shivangi.
Yes, HDFC Bank was, quite a surprise today because it had been holding from the last 9 odd trading sessions, and today we've seen that there has been good short build up that we're seeing. RSI is also turning a little nervous at these levels. Now the concern is that it has broken its 50 daily exponential moving average. So till the time it holds 750 odd levels, we could see some sort of recovery, but then not again a very swift one. The upside will remain capped for at least the next 1 week. But of course, we will see some consolidation at these levels and not really expecting a grave downside.
Okay, hold on to that thought. We're going to just take a very quick break. We're still in the red. We're down about almost 0.7% and haven't made much of a recovery since there. ONGC, Tata Motors, of course, continue to be your big winners. Technology, along with HDFC Bank and ITC, the biggest laggards today. Back with closing trades right here on ET now. It's a no-go really. We're just circling around the 24,100 print for the Nifty futures. 24,000 still being latched on to, at least as of now, for the Nifty spot as well. Technology, of course, is the one mainstay which is under pressure. But that's really been the case for the past many odd trading sessions. But Shibani, tell us how is it that you've read into the monthly auto sales data? It's been quite a mixed bag with positive surprises coming in from an iShares, from an M&M, even from a Maruti, but not quite the same from the other lot. Where do you see things headed for Motown in 2025?
So where the auto space is concerned, it's been a mixed bag. The way we are looking at the data is, of course, it's just 1 month of data, and then we will have to see whether the trends continue going forward as well. However, the way we are approaching the pack is looking at various segments where we are seeing some signs of improvement. As we were discussing earlier on in your show, that it does appear that possibly the mass market and the bottom of the pyramid rural segments, which were lagging all this while the premium SUV segments were doing well. Now, incrementally, it does appear that some of that demand, which was absent in the bottom of the pyramid segment, should start to come back. And therefore, look at companies which are clearly geared to that segment, both on the passenger vehicle side as well as on the two-wheeler space. Now, of course, this is a segment and the entire auto pack has seen significant correction, and therefore valuations are far more reasonable at this point in time. The way we have positioned ourselves is we have been overweight, especially where some of the two-wheeler names are concerned. And even within the overall passenger vehicle segment, we've looked at companies where, again, there is a significant launch pipeline. And we've also looked at companies which cater to the mass market bottom of the pyramid, where we do expect some amount of demand traction coming back on track. The expectation, of course, has been that post the festive season and the wedding season, there should be some uptick in terms of numbers. But we'll have to wait and see as to whether the monthly data that we saw for this month continues over the next few months as well. From a margin perspective, clearly commodity costs remaining under control help in terms of margins. But I think the major factor to watch out for will be the growth, especially volume growth, over the next couple of months as such.
Shivani, great to be chatting with you. Thanks as always for your time.
Thank you so much.
In fact, we were just chatting with Bajaj Auto Management as well earlier today, and here's what they had to say about where they see visibility on growth and demand coming in the next few months.
We have to see this in that context, the penetration increasing in the context of iScooters itself doing very well. The concept of EV in two-wheelers is here to stay in the mind of the customer. Any customer now today buying a scooter certainly considers EV as an option, whether they buy it or not, depending on pricing, power or purchasing power or other anxieties. That's a separate question. But almost everyone is considering e-scooters as an option. So it is very much here to stay. There may be some limits which will come upon it, like charging opportunities and stuff like that. But at this point of time, we definitely see, it's been growing at 30-35%. So we see that that growth rate with a little bit of bumps up and down, when policy announcements are made. But I think we can expect the growth rates to be 25-30% in the coming quarters.
Take coming in from Bajaj Auto Management, but let's take some closing trade ideas from our technical experts. Naresh, what's the closing trade idea?
So that would be a buy on PFC. The stock has seen an uptick today, and the base is set at 430 odd levels. Would expect some more follow-up going forward.
A breach of the 24,000 mark on the downside, so we slipped below that just a short while ago. Let's see whether we manage to recover from there or not. But we also have Shivangi with us, so let's try and take some closing ideas from her as well.
So I've chosen ONGC. The OMC companies are, much in radar right now, and ONGC has seen a good short covering move in the last two trading sessions. Volumes have spiked up today with the price confirmation here, and there has been a negation of the lower top, lower bottom on the monthly basis of the last 5 months. So of course, there is a lot of scope here. So ONGC is one on radar, which we can continue. 270 is the next targets, and with a stop of 253.
That's a take coming in as far as closing trade ideas are concerned. Hold that thought. Guys, we'll come back to you. But for now, let's listen into the latest views coming in from Ravi Dharamshi.
The manufacturing theme in India is here to stay. Whether it will be next 10, 15, 20 years, I believe manufacturing in India is on the rise. And there are confluence of factors driving that. Number one is China is facing a slowdown. And China is trying to move away from being, the manufacturing or the factory of the world to becoming a more inwardly focused, more domestic consumption focused economy. Now, that is a transition that China needs to make. So there is a need for them to move away from certain sectors. Second, world has realized that it is too dependent on China in some of the sectors and some of the strategic sectors as well. So they need to reduce their dependence. Nobody for a moment is suggesting that China is going to be replaced. But if China is 40% market share in a particular commodity, that might come down to 35% over a period of time. Or if it is 90-95%, as in the case of solar renewables, that will also come down. They cannot remain so dominant in a particular sector because the importance of that has now been impressed upon the major economies in the world due to what happened during COVID times. And third is, of course, India needs to, replace its agriculture as the main, agri and rural economy as the main source of employment for people and move them towards, urbanization, infrastructure, related employment and manufacturing related employment. So those are the three pillars on which the manufacturing theme is going to survive. Now, within manufacturing, there are many sectors and subsectors, and they will keep, coming into the limelight and going out of the limelight. For example, chemical was actually the first sector to take off way back in 2014, and it had a great run until 21. And then what we realized is that, China was not really vacating that space, but it was only moving its production away from residential localities to faraway localities. So when China came back into the market, there was a lot of dumping, which led to this manufacturing theme in China taking a big pause. So last 3 years, it's been on a pause, or in fact, you can even say taking a step back. Even though India might be gaining market share, but the profits have eroded for a lot of these chemical companies. The mantle moved to two sectors post 21. One was the electronic manufacturing sector, which is essentially the China plus one theme. And the second was the defense, but defense was more an import substitution story. So in the electronic manufacturing, I think we have started off on a great note where one particular subsector, which is the mobile phones assembly, is where we have done well to take away a lot of the market share. And that has led to a lot of replacement of imports with, in fact, now we are net exporters in the mobile phone. Of course, we have to still move up the value chain. We have to add a lot more value rather than just do assembly work. But that is where we are in that stage, in that story, where the component manufacturing is now getting relocated to India. It is not only about the assembly. And I think this is where the opportunity lies in the electronic manufacturing space, where some of these component manufacturers are going to see a good tailwind for the next 5-10 years. And the story will keep moving on from components eventually to maybe full assembly or the branded guys as well. But that story is for a future date. So I remain positive on the space, but there are certain companies in electronic manufacturing which are now quoting at valuations which are very, very difficult to justify. And they might be capturing in next 3-4 years kind of gains. So I would be a little skeptical about placing new bets in some of these old stories. So that's my take on the electronic manufacturing space.
Okay, point taken as far as that is concerned. But Ravi, hi, first wishing you, the best of 2025. But just wanted to get a better sense from you on real estate, because that is where there is a bit of a disconnect. Because if you go by anecdotes and if you go by ground reports, it does seem like that there is enough inventory. Perhaps there is increased discounting and those, good offers that the developers kind of give. But at the same time, the story and the numbers, point out to something else. And you are also quite bullish on real estate, even for 2025.
Yeah, thank you. Happy New Year to you as well. So real estate has been a very partially bullish story since the last 3-4 years. And I don't think any other sector, epitomizes the K-shaped recovery better than real estate sector. All the recovery has primarily been on the luxury end of the market. And the reason for that is also actually very understandable, because the growth in the market has been driven more by asset inflation rather than through income growth. And basically, if you have been an owner of gold, real estate, when I say real estate, land, or if you have been an equity investor, then your wealth has grown. And that is what is feeding into the luxury real estate cycle. But if you have been, a wage earner, income earner with not too much exposure to any of these asset classes, or you have not been an investor, then you have felt, you have failed to keep pace with the inflation. And that is what is hurting the demand at the bottom of the pyramid. So there is a strong need to broad base the real estate cycle that we have seen till now. If we really want, broad based benefits of the multiplier effect of real estate cycle, then we need to broad base it. And what we saw in the last budget, I think, is a reflection, and also that government understands it. So
that's the latest coming in from Ravi Dharamshi, but we have slipped below the 24,000 mark for the market, so just around that level, because managed to recover a slight bit from there. Let's quickly take a stock of what's happening in the market. Naresh, what's the view? IT continues to be on back foot. Wipro has actually seen quite a bit of decline, and even ITC. Surprising, because there has been an upgrade that came in on Wipro. ITC was expected to see some fresh buying ahead of that demerger, etc. What's the sense?
So we are seeing a pullback in a lot of names which were doing well yesterday or in the last 1 month. Say Wipro was the best performer in IT in the previous couple of months, and now that is taking a back seat. Same ITC, there is an event of demerger. We'll wait for much better price action after that. We could see some that adjustment happening tomorrow. So for now, Wipro around this closer to 290 mark would be a good entry point, which was the previous breakout for the stock.
Now take some BTSC trades from our chartist. Shivangi, what's the buy today, sell tomorrow idea?
So on my radar is Jubilant Food. This has been one stock which has been very resilient. Slight cool off from the day's high, but overall there is a lot of strength here. From the last 8 weeks, it's been supporting the upward sloping channel, and there has been RSI is turning positive for this one and showing good signs. So recommending a buy here. Now there has been a cool off in the IVs over here in this stock, which clearly indicates that bulls are poised to take it higher. So 790 is the next targets that I'm looking for, with a stop of 745.
Okay, those are some BTST trades coming in. Naresh, what about your strategies?
So first is the buy on PFC. The stock has dipped intraday and good basis set here. So expecting bounce back to continue the next couple of sessions. Stop loss at 462, target price of 477. Second is the buy on Britannia, which has seen a good correction from the top. Looks like a small reversal bounce back trade here. Stop loss at 48.20, target price of 49.40.
Okay, that's that on Britannia right now. Angel One, Zomato, Delivery, some of these new age platform companies are the ones which are seeing a significant cool off today. Other than that, of course, technology as well is facing the heat for sure today. But Shivangi, just wanted to, get you up to speed with some of the charts. Zomato as well as Delivery, and what do you now foresee? Does it seem like there could be a spell of softness or consolidation kicking in?
So absolutely, there has been a little bit of a cool off in Zomato, of course. Immediate short-term perspective, there might be more downside towards 265 odd levels. This is the next support that we are looking at. But positionally, the stock is very strong, and it's a must-have in the portfolio. In fact, new age digital companies are a must-have in the portfolio. There has to be some diversification. For that matter, just shifting a little focus here, Policy Bazaar is also one such stock which has remained in limelight from the last 4 to 5 trading sessions. So these are some stocks which are definitely a hold, and should be looked out for buying opportunities at any small decline.
Coming in on some of these companies. In fact, since we're talking about new age tech, here at what the fundamental experts have to say on the matter.
This space is bound to see a huge explosion of companies and business models over the next 5, 10 years or whatever, 3 years, whatever time frame you see. As a proportion of the index is bound to multiply from whatever low single digit it is today to first double digit and then potentially 20+% as it is in many of these countries.
So for me, in new age companies that haven't been around for a long time and have not already become very profitable is not something that I would be interested in. That doesn't mean that other investors are wrong when they're investing in it. It's just not my game.
Size of the opportunity is humongous. There is room for everybody. You have many more players apart from Zomato actually enter both the quick commerce space and the food delivery space, and the fast food delivery space also, the Cafe Zeptos of the world, so to speak. And, even Zomato has come out with a bistro, and likewise for Swiggy. And you'll have many more come through in the form of, let's say, a JioMart or a Flipkart, also announcing the quick commerce model. Size of the opportunity is very big. In retailing, and this be true for any form of retailing, you got to get your unit economics right. And if you get your unit economics right, that is to say per unit order or per unit quick commerce transaction, more than cost of capital, then the sky is the limit for you. And I think, Zomato has the first mover advantage. They have got the unit economics right. They have broken even. They are making contribution margin, which are positive. And now it's only about expansion into tier 1, getting economies of scale.
the market opportunity for them is so huge for these platform companies that I wouldn't be surprised maybe 5 years from now, 10 years from now, which obviously is a slightly longish time frame, but 5 to 10 years from now, they really kind of become amongst the top 5, top 10 Nifty companies. And that's going to come at the cost of some of these large FMCG product companies.
Right. Okay, that's the take coming in at some of the new age tech companies and how they should be treated. By the way, we've reached the 24,000 mark on the Nifty and closing in pretty much at the session lows, almost headed in for a 200-point decline as we speak right now. In fact, on that subject, let's just hear out some more of Nilesha's views. He also talks about what he feels about BPC, that's the beauty and personal care category, and how he sees that growing, much unlike what he has to say about pure play staples.
Growth in the BPC segment has been a tad lower, and especially in terms of the outlook. The outlook is not as strong as what one expected it to be, but I still believe that's a short-term phenomena. It's a bit of increasing competitive intensity. A lot of the private players, smaller players who are well-funded are pretty much out there splurging in terms of their spending on advertising and customer acquisition, which is impacting margins, impacting growth for the leaders. Second is channel mix. Clearly, many of them have relied on the general trade segment versus that quick commerce has essentially come in and pretty much stolen the thunder. And I think most of these product companies are trying to adjust or readjust themselves. Even I think modern trade on the offline side has been struggling and finding it difficult to cope with the competitive onslaught of the quick commerce space. So that's in turn impacting the product company. So I think it's a bit of several things playing out, but I probably think maybe 2 or 3 quarters from now, they should be back onto a strong wicket.
So you're saying buy on the given declines?
I think they look good. The segment look good. It looks very promising for the long term. I clearly believe that even the government's focus seems to be on the female segment of the population. A lot of the direct benefit transfers, which I earlier alluded to, are going directly in the hands of women and the female segment. And that essentially, if you look at it, even a part of that essentially goes into the BPC segment. It will be quite phenomenal.
I think the problem is the sector is too shallow right now. It needs
Yeah,
to
absolutely.
broaden. I think that's where
Yes.
it's stuck. But other than that, what about overall consumption? And let's pick on staples first. There is that slowdown. One has felt the heat in the earnings as well. But do you think the stock prices have absorbed all of that?
I think the big FMCG companies are continuing to face problems. My view is that they're facing a structural slowdown. Not because we are not consuming more, it's just the way we consume has changed and changed quite meaningfully. So if you look at all the big players in this space who've done wonderfully well for the last maybe 20, 30 years, not just last few years, but the last 20, 30 years, their mainstay has been essentially the general trade. The fact that they have access to millions of, the Kirana stores, neighborhood stores, which has helped them to enjoy margins. Versus that, on the product side, you've seen the entry of private labels coming. Second, we've seen a lot of well-funded, smaller challengers out there who are coming out with innovative products. And the third is essentially e-commerce and quick commerce. And with quick commerce guys, e-commerce guys, you're really not in a vantage position. You can't dictate the terms of trade. You have to essentially take the terms of trade as they basically give it to you if you want to essentially remain relevant in the minds of the Indian consumer. So I think they are facing a combined onslaught. Even in good times, they were growing in single digit. With this onslaught, I'd be surprised if they're able to kind of grow beyond 5 to 6%. Margin movements can happen a bit here and there in the short term, depending upon how crude oil prices change or how input prices change, but that's going to be still very, very ephemeral. Structurally, I think that's going to be a weakish place. And on top of that, they enjoy so high valuations. I mean, they trade at 40, 50, 60, 70 times just because they continue to remain capital efficient. But beyond that, equity investors look for growth. And they look for high growth, and in many cases, they look for hyper growth. That's clearly not what the large FMCG company is going to deliver to you. At best, there'll probably be a risk-off trade. If for some reason the markets get into a bit of risk-off trade, you would see some short-term money going out there. But beyond that, I don't think there's a case for the large FMCG companies.
But But Nilesh, these companies are your core portfolio names, right? Much like some of the large cap IT or the private bank names, at least erstwhile for sure. And traditionally, one has seen that these large FMCG stocks go into hiatuses of almost a decade sometimes, right? And when they make a comeback, it's like sort of no looking back kind of theme. Who do you think is going to win the race whenever they emerge out of this slump? I mean, is it a battle of pricing? Is it a battle of being in every consumer's hand? What's the fight for?
I still believe that this whole shift from the general trade to e-commerce, to modern trade, to e-commerce, to quick commerce is something which is basically going to continue for several years. And the big question for us as investors is, do you own the large product companies or do you own the large platform companies? Ultimately, both are proxies to consumption play. Okay, so that's essentially the big question which essentially all investors will have to try and answer.
So that's our latest coming in from Nilesh Shah. But in the meantime, Reliance is showing signs of breaking out in the sense that it's just up around 1%. But Naresh, the stock has been very, very range bound. I mean, 1200 to 1290, 1280 is the kind of range it has been holding on to. What's the sense on Reliance?
So in the last 2 days, it has clearly shown relative strength. Even today, when the markets are correcting, the stock is holding up. So in this case, it is the first time in the last so many weeks we've seen Reliance outperform. This could very well be a start of a bounce back and then a basing out formation. So I would expect it to go towards the 1300, 1330 mark and then take a pause. So for now, positive on Reliance at current levels also.
Shivangi, we'll let you go on that note, but you know what, come Monday we'll also be watching out for ITC because it will go ex the hotels business. Let me take it across to Sharad, who's joining us to talk to us about what brokerages are making of it, what kind of valuation do we expect for it, what kind of profitability etc. Street is working with. Sharad, take it away.
Well, it's important timeline coming in. January 6th would be the record date when it comes to determine the ITC shareholders who will be eligible for ITC hotels after the demerger. Now, so of course, if you're an ITC shareholder, if you're holding 10 shares, you will be getting 1 share when it comes to the ITC hotels. Now, how's the price determination happening? That will be very important, and as per Nuvama, it stated that based on the difference between ITC's closing price on 3rd January and the opening price on January the 6th, there would be a special trading session where the price discovery would be coming in. Now, what's the impact coming in? The domestic brokering houses have stated that ITC hotels will be maintaining a constant price difference from January 3 and until the special pre-open session which comes in, and also it will be excluded from the indices in the 3 business days after its listing date. Of course, there won't be any circuit breakers as well. If the stock hits circuit limits, the exclusion will be postponed by 2 trading days each time. Now, the brokerage stakes is also there. It's important at what could be the important fair value of the ITC hotels business. Nomura is stating ITC hotels could list between 200 to 300 rupees per share, indicating a market cap ranging between 42,500 to 60,000 crore rupees, while Centrum Broking has also given a target price of 583 for ITC. That would adjust a 17 rupees per share post merger, while for Nuvama the initial market price for ITC hotel ranges between 150 to 175 rupees, and the ITC's price could be adjusted by 22 to 25 rupees post merger. For SBI Securities, looking at the numbers, the implied fair value of the ITC hotel business ranges between 113 to 170 rupees, with the adjusted price of ITC post demerger coming between the range of 470 to 473. So this is how actually it's panned out, and of course, like how Geo Financial listing has happened, so somewhat on the modus operandi would be coming in that way as well. But a lot of more details coming in, and we're joining us is Prashant Biyani of Elara Securities, where he'll give us more light on ITC.
Play that soundbite from Prashant Biyani, but let's just wind up the markets before that. And what a week it has been. Starting off 2025, it's the Nifty autos which have actually been the best performer in the week gone by, with a 4% return that the Nifty Auto Index has given. Energy, of course, has done very well, led by moves on ONGC today itself. About a 2.5% uptick on the index on a weekly basis. FMCG as well made a sporadic comeback. In fact, some of the days we've seen some big moves from some of these staples. Case in point being today's move, for instance, 2.5% of an uptick on FMCG. PSU banks have done okay. It's actually realty and banks which have been the laggards in this week's session. The top mover on the Nifty in the week gone by has been ONGC. The major chunk of the move on ONGC, of course, played out today when one of the brokerages upgraded the stock, indicating a significant amount of upside to the tune of about, I think, 40 to 50 odd % from its current market price. Eicher Motors reacted very smartly to its monthly sales data. And then, of course, there was Bajaj Finance and Finserv as well, which held out very well. Wobbly week for IT. Wipro was your top laggard. And yeah, ICICI Bank and HDFC Bank as well saw a fair amount of pressure in the week gone by. Dr. Reddy saw some profit taking, as did Hidalgo. For the day, of course, it's been all about DMart. That's been your star today, a 12% uptick coming in. It's managed to beat the street estimates in terms of their Q3 updates. And that's something that the street is like, although the brokerages continue to downgrade the stock. Angel One, Nalco, Zomato, Delivery, these have been all of your laggards in the session. On the winning side, from within the broader end of the market, there's also been the likes of some of the other names which have seen a move coming in. So Oil India, IGL, SBI Cards, Dabur, these have also been all gainers. But that's pretty much it in this edition of Closing Trades. We wind up for the week. It's a goodbye from Anisha and me.